Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm pleased to be joined again by Chris Grisanti, MAI's Chief Equity Strategist, to discuss the many crosscurrents facing the market and how investors should be responding. Chris, thanks so much for joining me today.
Sure, John. It's good to be together again.
Well, Chris, you recently authored a piece titled A Roadmap for a Volatile Market, in which you gave our clients just some things to think about as they approach a more difficult market ahead. As you think about the current environment and this proverbial wall of worry that seems to be getting larger and larger by the day, what are some of those investing principles that you think investors should be keeping top of mind?
Sure, John. Well, you're absolutely right. I mean, it's easy to do our jobs when the market's going up, but it's much more difficult in the volatile market. And I think there are a few principles that are good both so that you do well on the market and also so that you don't kind of go crazy worrying about it. And the first of those is really freely acknowledge what you don't know. There's a lot of stuff right now that we just can't figure out. And it's not our shortcoming, is that no one can. So, for example, we don't know how high oil prices are going to go. We don't know whether that will throw us into a recession later this year. We don't know how the war in Ukraine will resolve itself. And these are big issues in the short term. But, and this is important, once you appreciate that you can't know those things, then you can sit back and say, how should I invest in this kind of volatility and this kind of uncertainty? And the answer is that actually gives you a bit of an advantage. You say, no one can know this, but people are panicked about it. And therefore, if you focused on long term investments that can make it through to the other side, even if there's a recession, even if the war in Ukraine continues for quite a while, then you're kind of, I think, ahead of the game. So that would be the first way. The second way is, again, don't get too scared. Don't what I like to say is don't invest with a ruler. Don't take the current trends that we've seen over the last couple of months and project them in a straight line. So because oil's gone from 60 to 80 to 100, that doesn't mean it's on its way to 200. And likewise, with falling stock prices, don't say, oh my gosh, the market's down 5%, 10%. That means it's going to be down 25. There are dynamic processes in here. And if oil keeps rising, things will happen to make it go back down again. So don't invest with a ruler and freely acknowledge what you don't know. That would be my first two steps.
Well, that's very helpful. Since you mentioned it, I'd like to key in a little bit on oil prices as well as interest rates, both of which, have been rising now into more uncomfortable territory for the market. If you look back historically on what have been the factors that have been precursors to bear markets, rising oil prices, Fed tightening cycles would certainly be near the top of the list. So, curious your thoughts on both of those issues for the market right now. Does it inevitably going to lead to a recession?
Well, I think you put your finger on it, John. I think that, sure, these are very reasonable concerns, but they don't automatically lead right down the garden path to a recession or to a bear market. First of all, as an empirical matter, you can look back in history. For example, in 2011 to 2014, oil hovered around $100, going over it numerous times, and yet the market actually was up real nicely during that period. And another thing that's even more important, I think, because interest rates are even a bigger worry than oil prices, are that the market can do okay with rising rates. Look, rising rates are not what you want. You want low rates. But rising rates are generally caused by good things like strong earnings and an otherwise healthy economy, low unemployment. So those are all good things that can push the market forward. The question is, in the battle with higher rates, who's going to win? Well, again, let's look back, and we have a chart here to show. From 2004 to 2006, the Federal Reserve raised rates 17 times. It's hard to remember, and that sounds ghastly. But in fact, the market continued up during that period and was up about 20% during those 17 rate hikes. So it's not inevitable at all that the market has to go down as rates go up. But investors need to stay focused on what they own, and their advisors can help them do that and help look out for the long term.
Well, that's very helpful. Certainly, those are the two big concerns right now, and that's helpful guidance for us. So, taking a little bit of a step back, we have clients that have been investing with us for decades. We also have clients that have been investing with us for months or maybe a year. And I'd like you to speak to that latter group who may be facing elevated volatility for the first time. What's some of the counsel that you would give to that group of investors?
Right. And that group of investors are typically the folks that call and say, oh my gosh, the market's going down. Should we sell? And it's a totally normal human response to what's going on. But the dirty little secret of our business, John, of course, is that we don't know any better than they do when the market's going to go up, when it's going to go down. And so the most important thing to remember, it's not timing, but time that leads to strong returns for investors. So, in other words, don't try to time it. Try to stick through the tough things and try to buy the kinds of investments that will help you get from here to there. So, what I like to do is point clients towards a chart of the S&P 500 over the last 30 years. And I'm going to look at my notes here. Since 1992, 30 years ago, the S&P has fought through the following volatility-causing events. The savings and loan crisis, the first Russian debt default of 1998, the dot-com bubble bursting in 2000, the war on terror, of course, 9/11, the global financial crisis, the downgrading of U.S. sovereign debt in 2011, the election of Donald Trump, the election of Joe Biden, depending on which side of the scale you're on. All of these things, not to mention the arrival of COVID, scared a great many investors. And you could have been reasonable at the time and said, oh, I'm just getting out. And you might even have looked smart for a few months, but you would have missed an exceptional return. It's up 1,900% in the last 30 years, an average of over 10% a year. And if you had let any of those events scare you out, you wouldn't have known when to get back in all probability, you might not have gotten back in. So again, time, not timing, is the secret to great investing.
Well, Chris, thanks so much for joining me today and for your insights as always. Volatile markets are a big test for investors, and how we respond in these periods can have a major impact on a client's financial future. Even when the outlook is the bleakest and the range of short term outcomes has widened, staying the course through the inevitable ups and downs of the market has proven to be the best strategy for achieving long term goals. As always, we greatly value the opportunity to partner with you in this important aspect of your life, and we'd encourage you to reach out to your wealth advisor at any time to discuss your personal situation in more detail. Thanks so much for listening, and we'll see you next time.